Hello and welcome. We are continuing with May, June 2018, paper 13. We are doing question 15, I think 15 to 25. Let's just be prudent here and not overextend ourselves. So if you can please join me, we are now doing question 15. Hope you can read there with me. The total equity of a company on the 1st of January was 400,000. And the following information is available at the year end. Okay, so it's always nice to have a 1st Jan to 31 December because it's the same year, 2017. But we have to now consider everything that happened and how that affects our equity. So if you like, you can draw a financial year, 1st of Jan, 31 December. Let me just show you how I'm setting this up for myself, and then you can choose how you want to set this up. Obviously, you can't take too long to do this because you only have 2 minutes, like we said in the previous video. So 1st of Jan to 31 December 2017. And then maybe what you can also show me is that we start the year with 400,000. Okay, it's just to orientate yourself. Sometimes it's useful to count the months, then to know how many months, let's say it was a debenture or something that there's interest. It's nice to just see it laid out like this. Then I would like you to see all the things that happen. On the first thing there, maybe you want to read it with me. There was a rights issue of 20,000 ordinary shares at $1 each at $1.50. So why is it higher? Why did you go over your nominal rate or over your par rate? It's because of the share premium. Okay, so it doesn't matter the date, but I am going to show it somewhere here in June. We issued 20,000 new shares. I do like splitting it up into $1 and then 50 cents. You just have to read very carefully. Sometimes the way they word it, is it already in there or is the premium $1.50? Or it does sound like we issued them at $1.50, which means it's 50 cents above normal. All of these were taken up. Okay, so we can record that. The profit for the year, why do they mention profit if we're talking about equity? Remember, profit gets added to retained earnings. So we do have to also add 45,000. Obviously dividends would also, yeah, there's dividends. I was just thinking if there's profits, there's probably dividends because that then gets subtracted from retained earnings. I also just want to mention something with the rights issue. If this was a bonus issue, no equity change because the one equity just goes into the other equity. So rights issue, okay, profit, dividends paid during the year was 8,000. That normally gets subtracted from retained earnings. And there was a proposed dividend at year end. Proposed dividends we normally shouldn't look at all when it comes to changes in equity because it's just proposed. So I'm going to leave that out for now. And transfer to general reserve, don't fall for this. They're just taking one equity into another equity, normally from retained earnings into general reserve. So I'm not going to fall for it. I'm not even going to write it down. So please use your calculator. Let's start this journey together. 400,000 plus 20,000. You can say times 1.5 if you want. Only if we had the accounts would we have to split it up into share premium and ordinary share capital. Plus 45,000 for the profit minus 8,000 for the dividends. Let's see what you all get. 467,000. This is a good start. Just have to warn you, I also sometimes do make mistakes, but this one, we were on the ball. Okay, number 16, a little bit of theory. A company makes a bonus issue of shares, you don't get money. What is the correct effect of the SFP? Well, share capital, if you think about share capital, ordinary share capital does increase, but equity doesn't increase. So I just quickly peeked. I think we must aim for at least a share capital increase. But be careful if this said equity, that would be no effect. Total assets, if this was a rights issue, we could have said yes, increase because we get money. It would increase current assets because of bank. But I want to go 16D. Little bit of theory. Some of these will be quick. You must be thankful for ones that take you less than 2 minutes. A company raises finance by issuing debentures. It's like a long-term loan. What is the effect on net current assets and short-term profits? So remember, because you are getting money, your bank will definitely go up. So I think for 17, we're going to aim for an increase in net current assets because of bank. The problem with our short-term profits is because we have to pay debenture interest, or short-term profits will decrease. Obviously, long-term profits, maybe we're doing something amazing with these debentures and we're making a new branch and getting more profit. But in the short term, it's not great to have debentures because of the interest. Okay, 18. Why would employees be interested in their employer's financial statement? Remember, some of these might be true, but we're looking for the one that is the most correct. To assess whether the business can continue to trade, to compare their salaries, to put a value on goodwill, or to understand the impact on the business's impact of the business on the economy. All of them quite possible, but I want to go and check the most correct version. And that is basically job security. They could have said job security to see if they will go on trading. Obviously, also to see the salaries. I don't know if you'll be able to see that in the financial statements, but that's not the main reason. You, as an employee, you would be an interested party. Okay, then 19, a business has provided the following cost of sales, gross margin, and then profit for the year. Remember, gross margin works with a total of 100. It doesn't go like markup, it doesn't go over 100%. What was the expenses to revenue ratio to the nearest whole percent? So I hope you have a cheat sheet close by. I call it a cheat sheet, but I will quickly show you what I mean with that. So I just quickly went to go look for this. I call it a sheet for my grade 11s or my AS1s. I normally print this out and they use it, but you're not allowed this in the exam. So you have to go and study this off by heart. So if we can just read the question again. It was question 19, the expenses to revenue ratio. So unfortunately, we're not given revenue. So expenses to revenue, we can make revenue X if we had our expenses. So let's just go see exactly what we have. It looks like we don't have expenses, but we have ways to work this out. Remember, the gross margin can help you to get the revenue. It can help you to get gross profit. So let's just quickly go work back from this gross margin. We've got 240,000 cost of sales. So if you type in 240,000 and you want the revenue, you can say times by 100 over 75. Remember, that comes from the margin adding up to 100. So if you want revenue, that is 100%, but currently you are stuck with cost of sales, which has the 75% because you've already minused your margin, which is 25%. So the leftovers would be cost of sales, 75%. I hope that still makes sense. You can draw a little block for yourself to make sure that that always adds up to 100. But if I go 240,000 times 100 over 75, I get my revenue as 320,000. Maybe you can write that down for yourself somewhere. If your revenue is 320,000 and your cost of sales is 240,000, maybe go work out what your gross profit is. My gross profit is 80,000. You could have also gotten that by taking 240,000 times by 25 over 75. 1 over half. I still get 80,000. I hope this is sinking in. Because now I want to ask you, what happens from, let me just keep a little tally here. What happens from gross profit to net profit? Normally just expenses, right? So if I put here 16,000 and I work out how much my expenses were, so the difference there, 80,000 minus 16,000. Looks like my expenses amounted to 64,000. And then if I want, remember that formula that I showed you originally, if I want expenses to revenue ratio, I go 64,000 over 320,000 and then times by 100. This is just how I'm doing it on the calculator so that you can see. So just a quick reminder where this is coming from. It comes from this formula sheet. This formula sheet. expenses to revenue ratio. I was also using this margin, gross profit margin, where it's gross profit. You're welcome to obviously use this formula with an X in as well if you don't like want over have. I just feel like want over have is always the quickest way for me. Okay, then question 20. So just make sure that you agree with me. We're saying 20% then for this one, even though I can't get there. 20%. Okay. For question 20, a business apportions. Okay, so this is definitely manufacturing. So this is the chapter that's normally question 4 for paper 2. So just make sure that you have your manufacturing brain on. Business apportions some of its overhead expenses across its production departments. Why might building maintenance cost not be included with the other overheads being apportioned? Let me work this out. So I think with this one, just read through each option carefully. But remember, building maintenance can be identified with specific cost centers. So you can say that this cost center cost this much for maintenance. We had to fix this, we had to fix that. So you don't have to include it with the other overheads that are more difficult to go and identify with a specific cost center. So unfortunately, this one, my only advice here is to go and study your theory. I always tell the students in my class, I'm not your business studies teacher. So I feel like here, just go through your theory again with apportionment. We normally do apportion things that we can't really attribute to a specific cost center, and then we will spread it across our production departments. So I'm going to leave that one for you, but I'm going to tell you D is the correct answer. Then 21, the following information is provided by a hotel for a 30-day period. So here your math brain needs to be switched on. What is the average cost per occupied bed per day? So you must remember what things are available here. There are 180 rooms with 2 beds and 60 single rooms. This is your average occupancy per day, the number of guests in that period, and average length of stay is 2 days. Your payroll and cleaning cost is 3,000. So now I want to know what is the average cost per occupied bed per day. So now remember there was only 150 2 beds and 50 singles. So I don't know if you want to start writing these things down, but we can also just keep it on the calculator. Let's maybe start a tally together. You mustn't overthink this one. I did keep a tally now of 150. They have 2 beds, and then 50 rooms have 1 bed. They do sometimes put extra information to confuse you, but basically, let's see how many occupied beds there were over 30 days. So 150 2 bedrooms and 51 bedrooms, and then I times that by 30. So basically, we had 10,500 beds over this 30-day period, and our cost was 300,000. So I just want to go 300,000 divided by that. 300,000 divided by that, and then let's see what we get. 28.57 dollars. The reason that's actually question, let me just show you. That will be answer 21B. The number of guests and how long they stay, remember that's already included in the occupied rooms per day. That now average number of occupied rooms, that's been already based off of the information of how many guests were there and how long they stayed. So I was just using the 150 and the 50, so don't get distracted by the extra noise. Let's go on to 22. Remember, we're only going to go up to 25, so 3 more questions. The following information is available for a manufacturing business. What could cause an overabsorption? So, oh, sorry, an underabsorption. So an underabsorption is not good. That means that it actually gets deducted from your profit. It means that you under prepared for your costs, your fixed costs. So an underabsorption could mean that your actual machine hours were higher than your budgeted. Can I already just say that one? Your actual machine hours, oh, that it's the wrong way around. If your budgeted was more, then we would have been able to say that. Sorry, let me just re-explain myself there. I got caught up. The underabsorption, if I look at A and the budgeted was less than the actual, that's actually a good thing. That will result in an overabsorption. Because then inside your machine hours, you obviously have an OAR and you're covering it in more hours. So that would result in an overabsorption. If your overhead expenditure, if your budgeted figure and your actual figure, if the actual is lower, that's also a good thing. That will result in an over absorption. Because if you're in my class, if you're thinking about the cloud was actually smaller than you thought, which will result in an over absorption. This is the only issue that I've seen so far. The production unit, your budget was 5,000, but your actual was 3,000. That means if you're in my class, if you think about the cloud and the raindrops that come out the cloud, the raindrops were less. You thought you could split it into five layers or five things that you're making, but now you're only making three. So now your absorption would be under absorption because you're producing less than you thought. Selling for now is actually irrelevant. So I actually want to go with question 22C. I have indeed lost the ability to circle. So 22C, please. And then let's go on to 23. We're almost done. A business produces two products for the month of January. Overheads are absorbed using the direct labor hour. So obviously they're more labor intensive. That's normally how you choose what to do your OAR on. The production details are as follows. So for P, we've units manufactured and sold with 5,000, and for Q, 2,000, and then direct labor hours per unit 1.5 and 1. The direct costs per month were that much, and the fixed overheads were that much. What was the OAR? So remember for the OAR, the formula that we normally use, let me just quickly write that down. We want to get our fixed cost. Sorry, just give me a second. So we want to take our fixed cost over our direct labor hours. Direct labor hours. That will give me my OAR. So we need to first of all look at what our fixed costs were. The fixed costs were 6,500. And that's going to be then over, you must be careful with your direct labor hours, how many there were, because of P, there was 5,000 and you had to spend 1.5 making each one. And of Q, there was 2,000 and you spent 1 hour on each of those. Sorry, I don't think you can see. So if you just quickly use this basic formula and type it into your calculator, you should get 0.684. Let's see if there's an option like that. Yeah, 0.68. And then obviously if this was paper 2, you'd have to say per labor hour. Okay, obviously here with the direct costs per month, we ignore that. We want fixed cost. We don't want variable or anything else like that. That's for 23. We're saying A. 24, the following information relates to a business for a year. How many units were sold? Okay, so let's just see what we can do with this one. Selling price, variable cost. Remember, then you can get contribution per unit, total fixed cost, and then profit for the year. So let's go see what little formula we can use here. We can use that formula that normally helps us to get target profit, where you go fixed cost plus target profit, or in this case, actual profit, over contribution per unit. So contribution per unit, we spoke about it just now, selling price minus variable cost. And then if you get that answer, that's how many units you should be selling to get a profit like that, or to get a profit of 15,000. So if you type that thing into the calculator, that'll give you the amount of units. I get 2625. Let's see if that's one of our options. 26. Okay, so 24D. There we go. Let's just quickly finish 25. What will result in an increase in the margin of safety? Let's just go read through all of those options. So margin of safety is obviously, if you think about what you're busy selling versus what you need to break even. So if you're thinking about break even, that's basically your fixed cost over your contribution. And if you're thinking about margin of safety, that's how far away you are from break even. So you actually want your break even to be less so that your margin of safety increases. And to make your break even go down, you must either let your fixed cost go down or make your contribution per unit go up. And I think that's what they're giving us options for here. They're giving us options. If you get a trade discount, obviously trade discount, that'll bring down your direct materials. So yes, you want a higher trade discount. So those C and D, I don't want not accepting a higher trade discount. We want trade discount. But the problem is a trade discount might cancel out then with an overtime. If you're paying more for overtime on labor, that might make your contribution per unit be the same. You want your contribution per unit to go up so that your margin of safety can increase because your fixed cost and or your break even point is then decreasing. So what I'm trying to say here is you want to accept the higher trade discount, but you do not want to offer overtime on labor because you want your contribution per unit to increase significantly so that your fixed, what am I saying? So that your break even point can decrease so that your margin of safety can increase. I hope I didn't confuse you there with my wording. But that's basically what I wanted you to do for 25. So 25, we're going with option B. And I think that's a wrap. I'm going to have another cup of coffee and then I'm going to do 5 more questions. Then we are done. Thank you. Bye.